Hiya. Hello.
Hi, Michael.
Hello. Hiya. Thank you for posting the link there. Thank you very much. Very kind of you.
Yeah, just made it easy, you know,
Thank you so much.
keep people on it.
Thank you very much. Thank you. Um, Hi, George. Um, George, I wanted to say, listen, thank you very much for, all your support. There were times when it was just me and you on this call, and it was, if it wasn't for you, I wouldn't have done these calls, and I kept pressing through it, and, I'm grateful for that. But at the same time, if you feel like you want to do something else that's better than spend 30 minutes with me, I totally understand. I won't begrudge you.
No,
Um,
no, I enjoy very much, and it's an honor. And you're like you're such a treasure, Michael.
oh, thank you.
Personally, professionally, I'm happy to be here, and I'm sorry if I praise you too much online, but
No,
I
no,
can't
sir.
help it. I've lost so much money in the market through decades. I've been investing since the 80s, and you make it look like almost like it's an automatic, and it's so super hard. I'm in awe of you, so I can't help
Oh,
but
thank you. Thank you very much. It's really, really kind of you. Um, well, I think it's going to be a small call. I think it'll just be the three of us. There was a question that Jordan said that he wanted to find out about. Um, and he said that he wouldn't be able to come on the call, but he wanted to kind of find out a little bit more about how I do the fundamentals of investing. And in my experience, this is my belief. There are many different ways to invest in the market. I get that, that's fine. But in my belief is that the fundamentals, getting the fundamentals right, is superior to technical analysis. This is my belief. There are many beliefs out there in the market. There's many religions. That's fine, but it's my belief that the fundamentals, doing good fundamental work, will beat technicals. It's my belief. But it's also my belief that emotions beat fundamentals. So having the right emotions in place is the difference, that small edge that that makes the drives the outperformance. Now, you know, there are periods of time, like 3 months, whatever, where stocks go up or down or whatever, and you kind of don't really see the fruits of your labor, and you kind of plodding through this damn river, man. It's like you're trying to knuckle down the process, and at the same time, you're just not gaining a lot of ground, and but being prepared before you make that investment, being like with the mindset that you don't have to take anything, you don't have to when it's a bull market like now, it's like everything is going to the moon. um People just want to know, like, what can I buy? People are so excited, and you know being able to, and it's difficult. Listen, I'm not going to pretend that it's easy, I know that, but being coming to the mindset of two things. Come to the mindset that even if you don't find something today, that you are gonna find something tomorrow. Okay, that's the first thing. That's really, really important. If it's not aligned right now, that's okay. I will, like, something will show up tomorrow. So that's the first thing. Okay. And the second thing, like kind of what you were saying, George, you know, I think very hard about capital preservation. And this is something that people talk about, like people love to pound their chest and say, oh, don't lose money, Buffett's rule number one, and all that stuff. But you know, like people like you guys on the call, none of us are getting any younger, right? So you have limited amount of time. And I don't want to give up that hard work. I've put a lot of hard work into accumulate those savings, and I don't want to lose that. I don't want to lose that. So I am working so freaking hard to try my best because that's the time, right? I see money and time in the same kind of equation, and if I've accumulated that amount of money, it's the time that's a measure of time really that I've accumulated that I can give. I can give to Daniel, I can give to whoever. That's time. Like the accumulated time I can give to whoever that has value. Okay, so in the line of preparedness, when I look at the fundamentals, I try to simplify what I'm looking at, and I try not to make it too complicated. What you're really trying to do is say, listen, I think the business is going to make this amount of profits, okay, next year. And then you work from that, okay? Now, what gives you a certain level of confidence the business is going to make a certain amount of profit? I talk about free cash flow, but people, you can talk about whatever, it doesn't really matter. As long as, the work is kind of right. But I like free cash flow because I feel kind of, that's kind of like my safety net, let's say. I kind of like, when your back is against the wall and everything is kind of breaking down, that's your safety net, that's your, like, the back against the wall is the free cash flow. If you got the free cash flow right, even if your entry price isn't great, a lot will be forgiven. So, for example, in my opinion, Samsara is expensive, but I think it's worth it. So the back is against the wall. I kind of think, okay, I know that in 12 months they're going to make, well, I don't know, but I feel that in 12 months they're going to make X amount of free cash flow. So I work backwards from there. So what gives you the certainty is a business that is stable. That's really helpful. Okay, so you don't want, let's say, for example, a business that in one quarter revenues are very, very strong. Next quarter revenues are kind of petered out. The quarter after that, the guidance looks strong. It's like all over the place, and it's difficult to kind of get confident on the amount of free cash flow the business will make. So I want a relatively stable business. And the other aspect that gives a lot is if the business is growing. If the business is growing, a lot of things can be forgiven, okay? So number one thing that I think is really, really important is get the balance sheet right. You don't want, a lot of debt on them. So that's the first thing. The second, so I was talking to Jordan and he was like, oh, I've been investing for several years and I'm the CEO of a company and, I talked to other CEOs, but like he was like, oh, but how you do the fundamentals are really good. And I'm like, it's nothing that you cannot pick up in like accountants for dummies. It's like I'm not doing anything that's particularly smart. And I'm not even going to pretend otherwise. But if you start with a business that has strong financial footing, a lot of things can move around and you're going to be okay, So that's a good place to start. Second, a stable business. Ideally, you get a business that has some growth, some momentum to it, but that's not really always required, okay? So an example that has worked for me where I didn't have a lot of growth is Peloton. I would like to believe that in 6 months' time, I'm going to say that Teladoc was like Peloton. Question mark still there going, but ideally, you have some growth. But if you haven't got a lot of growth, you have stability. So for example, Teladoc, yeah, there's not a lot of growth. They got some churn in their customer base, but they got some pricing power. They kind of get a stable business. Stable, a lot of things can happen positively, provided the business has figured out how to be economically viable. By that I mean it makes a lot of free cash flow. But you know, you don't need to like make some really accurate assessment. So just to recap this part, get a business that is stable. Because if the business is stable and they make a lot of cash, something positive can happen along the way. It's not always the case, but something positive can happen. And sometimes, you know, if, for example, the business has a lot of cash, in 2023, I recommended Broadcom because it had a lot of cash and it was making a lot of free cash flow. It wasn't growing a lot, but they made a massive acquisition and that boosted that return. But simply put, you don't need to know a lot about the fundamentals of the business. What you need is a stable business. This is really, really important. So Jordan, if you watch this, let me know if that kind of helps frame some stuff out. If not, drop me, like we discussed, 2 or 3 questions, and then we can kind of take it from there. The next part, so I'm reading this book called Deep Survival. And this book is about people that have been in different types of accidents, like, for example, falling out of a plane, or skiing and falling out a mountain, or getting lost in the jungle. What causes a person to be a survivor in that circumstance, in those circumstances, versus people that have been in exactly the same setup and didn't survive? So it's not, you know, a science, but generally speaking, the survivalist is able to embrace an open idea, okay? So they don't take their experience that they've accumulated in a different environment as being able to be transposed to this environment, okay? So hypothetically, they climb a mountain, the mountain that they've climbed in the past looks similar, but there are some uncertainties in the outcomes that they believe that their prior experience can be superimposed here. Whereas the people that actually do survive, they say, hey, I don't really know what's going to happen, so I'm going to have more uncertainty. We in investment talk about margin of safety, margin of error, but you know, have a tiny bit more cautiousness and say, actually, let's just be careful here, you know, take it a bit slower and be a bit more open-minded to the different environment that's taken place. And the last thing that I feel is helpful is to think about, and listen, I'm like you guys, right? Like, I know these things, and you know, I say these things, and people kind of nod their heads. They're like, yeah, that makes sense. But when you make a portfolio of stocks, let's say you got, I like to kind of work around with 20 stocks, but you know, whatever, you can have more, whatever, it doesn't matter, you can have less. There are certain businesses that are going to reach a fair value quicker. And what I said at the start of this call was about being prepared. So so I don't like using stop losses. I strongly recommend that nobody on my stocks use stop losses. I say this every single time, but nobody cares. But you come in prepared and you have a view. And if that outlook is pulled forward and people generally agree with your perception, and the stock reaches, you know, a fair value sooner, that means the outlook at that point is more rosy, okay? I like to sell into that rosy outlook, okay? Because I came in when the share price was lower, and that outlook is now great. So I like to buy a business where I'm getting an average business, and then I'm selling it when it looks excellent, okay? And that is people saying, actually, I really think that I know this business better than everyone else, and I can have a better outlook over the next 3 years, for example. But when you buy the business cheaply, you can add loads of question marks. And I was talking about, we're talking about deep survival, like having allowing for different outcomes. So you are in your mind when you buy it cheap, you're kind of like, okay, I don't have all that. I don't know all the answers. I don't know how the cards are going to fall, but you don't need to know because you bought it cheap. But when you sell it into strength, you're selling it to somebody else. Somebody else is taking that business from you and say, I know more than you, and I'm willing to pay a higher valuation because I have more certainty than you. So there are two types of setups here. There's a type of setup that says, hey, I don't know, but I'm willing to say that I don't know, and I prefer to walk away with some money rather than trying to figure out how the cards are going to fall over the next 3 years. That's a more challenging game. Now, we're in a bull market right now. Like I've not seen like for a while. 2020, like it from September into December was like this, but that was felt short-lived. This one is just going and going and going and going. I can't explain it. But I can't. I'm not in the business of making macro calls. People love to make macro calls to make themselves feel hot. Like, oh yeah, I completed the market, blah blah. Whatever. The point is, it's much better to walk away with a gain, just lock it in, rather than trying to be the smartest person in the room, because there's always someone younger, someone with more resources, someone that's working harder than you. There's always somebody that can do better than you. And that's a tough game. What you want is a process that you can keep repeating. And I feel that's, a better way to go about life. So I'm just going to wrap it up here. But I just want to say one final thing, and it's going to be short. We'll all get a moment over, next couple of days or next couple of months or whatever, where we get a shock to the system and the portfolio is all bleeding red and it sucks and oh my God, what happened here? We'll all get that. But you can't control that process, but you can try to be a bit more patient. And the way that I summarize it as is lukewarm ideas, lukewarm performance. Top ideas, top performance. Just be focused, be selective. Don't just buy anything because it looks like it's got an enticing story. Yeah, that's all I wanted to say. I'm going to open it up for Q&A. Not sure if I got any. If anyone wants to ask any questions.
Hi, Michael. That was a nice summary. It's Daniel here. My question has been a little bit on I feel like your strategy has changed from the time that I've been part of the DVR group, and I think it's actually been really good, and I think it reflects really well with this kind of market. But I feel like your traditional liner was like holding for 12 to 18 months. And again, that makes sense when things are slower, but like things have been moving at like almost like warp speed, right? So like we're selling things that you were anticipating being like maybe, at least 6 months, maybe 12 months. And then like here's AppLovin's at 350 or Peloton's at, in 8, 9, 10. So, do you feel like I'm just trying to kind of wrap my head around you put these longer timelines, but like you're accepting that there's also a fair chance that certain things that are riding hot off like an earnings call are going to potentially be faster. And you're like, okay, I don't care if it could keep going. I'm going to stop it because I think I can find another thing that's in that less certain zone.
Yeah.
Is that kind of what you're thinking?
Yeah. So Daniel, I go for my jog on a Tuesday morning, and I normally think about George, but today I thought about you. And I adapted the strategy for you personally. Previously, I was more patient and willing to hold, for example, Palantir from 10 to 28, Uplovin from 40 to 208. I was more patient because I had this view that resonates with my personality. But as the subscription service grew, people like you wanted more ideas, wanted more ideas. And so I had to pivot to that. If I had, let's say, a ton of capital and I was just managing my own hedge fund, I would operate it slightly differently. But I have to be honest, I'm in the subscription business, I need to accommodate people. So yeah, I have changed and I had to learn new ideas. And the market is such a strong market. It doesn't matter. Like at the moment, every idiot idea is forgiven. It doesn't really matter. Like whether you're holding up love, holding Palantir, it doesn't matter. It's all to the moon, and everyone's singing and dancing, and it makes no difference whatever the strategy is. But I also have to accommodate to the subscriber base that people want new ideas. So it's kind of like you always have to adapt to your customer, and ultimately, yeah,
So Michael,
yeah.
I will say that, I agree that the market has been really good, but your picks have been exceptionally better.
Mm-hmm.
So there's no doubt, like if you compare the S&P to your picks, you are exceeding by a decent, if not high margin. Like, so, like that's where it's like, if you can nail all these fundamentals so well in these like short time periods, it takes off. Like you talked about selling PayPal at a 50%, then you buy Supermicro and then you sold that at 50%. That compounding is amazing. Like I couldn't believe it when I started seeing it in my own portfolio. So like that's where I'm very curious about that evolution too, because it seems like in some ways, because your fundamentals, when they're landing, they're like really good right now. So it's just interesting to think about, like, did we just condense these year-long processes into like quarterly periods, or is it just the market? Like that's what I'm just
It's
trying to
just the
kind of think
market,
about.
Daniel.
Yeah.
I'll be fair. It's just the market. Underlying the S&P, the smaller caps have been on fire, and it reminds me of the period of, I think it was 1968. I think is the only other period I remember. Obviously, the 2000s, but 1968 was a period that was particularly strong for small caps. I wasn't obviously alive then, but I feel that is how it is. But I also know that it doesn't last very long. Yeah, I'm trying my best to navigate this as best as I can. But I know there is the market, man. And when the market takes a breather, everyone is going to flee out of these small caps, and everyone is going to go back into, let's say, Apple and these kind of mega tech names, just to kind of shield away and hide away. And I'll be having to navigate that difficulty. And it's difficult because when the market slows down and small cap, everyone's going to rotate out of small caps into these kind of, let's say, Google, whatever, and the performance won't look as great. Yeah, but I'm going to try my best. I'm not going to just be like crying about it. I will definitely be working hard. Yeah, so it's difficult, but I'm like, I promise you I'm going to work hard. So I don't know. We'll see how it goes.
No, and there's no doubt in my mind. I think it's what's been interesting too to me is that like it's been working not only for these stocks that are like, what you would expect to kind of like be like a rocket ship, kind of like a lunar like happened,
Hmm.
or um, even Reddit, like Reddit
Hmm.
just took off, right? So, but it also has worked for stocks that are kind of the dogs too, right? Like
Yeah.
the stocks that like are kind of like dead. So it's that those like kind of dog stocks I would expect to take a lot longer,
Mm.
but like even those seem to have been fast. So yeah, it's kind of
It's the market, man. It's the market. It's the market.
yeah.
I mean, it is the market. That's it. The people are just in love with the idea that these small caps have been falling behind, and that the large caps have been for so long. So people love the idea of quote unquote broadening out, is not just being the Nvidia trade, but other things participating in this AI BS. I say BS. I know it's going to be the future of blah, but whatever, man. I just know that people are very excited, um, and I don't want to lose the discipline. Discipline is what drives success. You have to be super disciplined. You have to be super focused. You can't let. That's why I started to start to go. The technicals people kind of say, oh, like perfect example, right? Hymns. Okay, so hymns is flying like a rocket ship, flying, flying, flying. And the moment that I sold it was $28, and I was like, from a technical perspective, that looks so beautiful. It was like the best chart in the world. I was like, oh my God. But I was like, no, remain disciplined. And I sold it, and I was really grateful, and then I sold it. A day later, 2 days later, it was up above 30. I was like, whatever, man. Doesn't matter. Remain disciplined. And then it fell to 20. And I was like, whoa, lucky. It's better to be lucky than smart. Um, and obviously now it's back to 33. But would my subscriber base had conviction to stay with that stock as it fell from 28 down to 20. That was like 33% at one point down in 2 days. Poof! Like, I don't know if my subscriber base would have stuck around a bit. People would have lost a lot of confidence. Um, so it's not as important my performance. What is important is people like you, Daniel, your performance. When you are looking at your portfolio, and you see the performance. That's what drives loyalty, and that's what drives people to stick around. Um, so the thing that I'm trying to be very careful with is making sure that people are on the journey with me. Does that make sense? This is so important that people are seeing their portfolios compound alongside me. It's not so much important, what I'm doing in my returns is that people gain trust with the process. That's really what's key.
Yeah, and this strategy has been really working, I think, in that way because you kind of have like you said, it's like a repeatable rhythm as opposed to like these longer holds that have these ups and these downs. And like I feel like the more obviously this market helps, but like
Mhm.
there also have been just a lot of examples where things are going very nicely. Like, right. And so
Yeah, yeah, yeah.
that builds that confidence. I know I have a lot of confidence in you now based on all the stuff, I've seen. And George, you're shaking your head too. So yeah.
Yeah, that's cool, man. Thank you so much. Thank you. Thank you so much, Daniel. I'll open it up to anyone else if anyone else wants to ask any questions. If not, I'll just kind of wrap it up here.
So no question, but I also have complete confidence. And
Oh, Vasilis, this is the
yeah,
guy, right, guys? This is the guy that does a spreadsheet. Like, I cannot thank him enough. This is the guy, like, seriously, that we should all be grateful for. Yeah, thank you, man. Thank you so much. Um, yeah,
yeah,
thank you.
I actually started this seed because I wanted to see how the theoretical performance would be, and I could find the dates from your articles, even from the past before I started subscribing. And yeah, it's cool to have a benchmark of how the theoretical performance works compared to what I do. And actually, when I saw how well it works, the theoretical one, I just started copying it instead of doing my own thing. And because when you don't buy 5% the day you say it, and maybe
Mhm,
you buy 1% now, maybe
mhm.
you hope it drops, but maybe it doesn't drop. you add your bias of, so now I'm talking about people like Daniel, me, and George, that we do our own implementation, right? Then we add our bias of what we think will happen, and we don't have the deep know-how that you have. So maybe we will have some chances to screw it up a little bit. That's why I found that just copying you is as good as it gets. So yeah. But I'm much more convinced because of the sheet as well, right? Because it's obvious. It's like it's numbers. They cannot lie. So thanks a lot for this. I know you put a lot of work on this. I know you're squeezing your free time for us, and I'm very grateful for that.
No, it's fine. But if you think about it, Vasilis, I don't know what you do for a living, whatever, but you can't outwork me. I mean, you can't. You just can't. Anyone on the call, I will outwork anyone in what I do, right? This is what I do. This is my life. You might be very hardworking with your family, blah, 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 and your job and profession, etc. But that's the point of the subscription. The point of the subscription is that if you blindly follow me, you should deliver outsized performance. Interestingly, it shows that just if you're just blind to it and you just buy when I say you buy, and you just sell when I say you sell, even if you don't try and be all smart and try and buy the dip or whatever, if you just forget all that nonsense and just follow the spreadsheet, the returns speak for themselves. Because, it's like anything, I might kind of, I don't, but let's pretend I did. I might have a hobby of being able to fix something in my car, but if I take it down to the garage, the guy is going to do a much better job than me. Why would I think that I can do a better job than the guy that does this all day, every day? Same here. So, yeah, well, this is kind of the end of 2024 pretty much. I said, all throughout 2024, all I cared about was how 2024 was going to finish up. I have one more call with you guys next Tuesday, and I'm going to wrap it up there for 2025. But what I'm trying now is the enthusiasm that you guys have on the call right now is can I drive that forward to 2025? That's really, when the market takes the breather, when things slow down and everything goes red, can I drive people's enthusiasm? And just one last thing that I want to say is that think of it not as each individual pick. Think of it as, let's say, a combination of the five. Let's say you picked out 5 stocks. Look at the average of the 5. And because sometimes people think I bought this one and this one isn't worked out for me, and they kind of feel all bad when I say, okay, this investment, for example, GitLab hasn't worked out. I want to sell it. I just want to park this idea. And people kind of but I bought it at a higher price and now it's down. And what shall I do? And I'm it's not a perfect game. It's an art, right? It's an art of investing. It's not perfect. So it's not like a computer system. You type it in and everything comes out perfect. You trying your best to this art to kind of understand what this organic thing, which is a business, what it could be. That's pretty much all I want to say.
So, talking about that, I wanted to ask you, how will your strategy change? Because I understand that, okay, now the market itself is skyrocketing, and obviously we do much better. But how does your strategy change, and what should we expect when the market itself goes really bad?
Yeah, that's a really good question.
Because from one side, I see that you buy stocks that look relatively undervalued compared to what we expect after the inflection. But at the same time, when the market goes bad, the inflection might not happen, right?
Correct.
So,
So that's a really good question. So what's going to happen here is something like your mental model should be something like a Giga Cloud technology, where I have a very strong view that I could get out at $45 to $60, but it's just, moving around this 20, 22, 23. It just takes a lot longer. So the strategy will be the same. It's just that between buying and selling may take 12 months or 18 months to get to that fair value. It's going to be a lot slower, which will diminish the returns that we will get.
Okay, I get it. Yeah, then this also answers to Daniel, basically.
Yeah.
Yeah, that ties in nicely because like that's what I'm thinking. Like some of these things, I feel like when I first started did take those longer periods, but I feel like it's been on warp speed right now.
Yeah. So it's just going to everything's just going to slow down. And I feel, a reasonable return will be 15% on average for the portfolio as a whole. So when things slow down, I feel like it's just going to take longer.
Okay. Okay, great. Thanks a lot.
Thank you, everyone, for the call.
Hi. Maybe you can highlight within your portfolio your top 3 ideas at this point, or 4.
So which platform are you on?
DVR.
Are you on Substack or are you on Seeking Alpha?
On the Substack.
Okay, so if you scroll up the comments board, every Monday before the open, I highlight 5 stocks that I think are good hunting ground for people to buy at average. You can just scroll up on the comments. It was written on Monday in the morning.
Okay, great. Thanks.
Thank you so much, everyone. Thank you. Have a nice day. Cool.
Thank you, Michael.
Thank you.
Thanks,
Have a nice
Michael.
afternoon.
Thank you.